Good morning, guys. Back at you again. Okay, so today, what we're gonna do is we're gonna go through some of the topics that, we went through when I went to the Santa Ana Hop and we did what they were, what's called FHA lender training. I had a big training deck and I gave it to Darshan to pick out, a couple of the things that, he felt was, that would be beneficial for us to go over. Now, I do need to be able to see, right? This is the number, no, it's same as this number, right?
Yeah, no, there's another number in the corner.
See, I can't see it. All right, there we go. All right. So can I shrink this down?
You should be able to.
Okay, all right. So this first page is the MCDS is the minimum credit score that we'll be able to use. The MCDS will be used to determine the maximum insured financing to a borrower with traditional credit. The table shows the relationship between the borrower's score and the LTV ratio, which they are eligible. Borrowers with non-traditional or insufficient credit histories are eligible for maximum financing, but they must be manually underwritten.
No sound.
Okay, so Sonia was just saying we wasn't getting any sound.
Yeah.
Yeah, I can hear right now.
Okay, perfect. Thank you.
Thank you.
All
I
right.
can hear you too.
Perfect. Thank you.
Okay, so again, if the borrower's minimum decision score is at or above 580, then they are eligible for maximum financing. But at 580 and below, the max LTV is 90%. Okay, so that's the key here. We have very few that are under 580, but I don't want to shut the door on those. If in fact you do have them, but we do want to make sure that we are working within the parameters of the maximum LTV when you are, originating the loan, and then of course in pricing it as well. Okay, so that was one, and then we're back to page 17. Sonia, what are we doing?
The microphone.
That's not connected.
So that's connected already? Okay, because maybe they don't sound well. Sorry to interrupt.
That's all right. All right, let me see. Then the other one's page 17, so we did go back. We didn't. Okay, so I got some. There we go. Okay, so again, now we're going to the other section to the credit score is the non-occupying co-borrowers or co-signers. And the first prerequisite is, of course, they have to be United States citizens or have a principal residence in the U.S. So of course, residency and whatnot, that's often a factor. So if you have any of your borrowers have any residency challenges, let's get those out up front so that we can start working on them. I don't want to wait until we're ready to send it to an investor or we're ready to post-close the loan and then have any hiccups. So as you're originating your loans, guys, and if you have any, borrower permanent resident or any of those things, please bring that to the surface initially so that we can start addressing it. The maximum loan to value for non-occupying co-borrowers is the maximum is 75%. Okay, the LTV can be increased to 96.5 if the borrowers are family members, providing that the transaction does not involve a family member selling to a family member who would be a non-occupying co-borrower or a 2 to 4 unit property. So summarize, non-occupying co-borrowers are acceptable when in fact they're family members, single family residences. If you are a family member to family member sale, then that does create a challenge. So just make sure that in originating the file, you want to go ahead and get that proof, when it's not obvious that, that they are related. Whatever, substantial proof that you can get, I'll definitely will look at it as favorably as possible, but I do need to try to tie them together. Okay, questions? You'll be able to see screens on key moments, highlights. What is that? Okay, yes. Hi, I'm AI assistant. Okay, okay, all right. Have a few wicked little chats going on here.
Do you mind if we ask questions as we go?
Yeah, you can ask questions. If you have any questions, hit me in the chat and then we'll stop. I don't want you to try and remember. I have no problem with that.
So in reference to the LTV, we had a file recently that it was related, it was family through marriage. And we had to get something like a birth certificate to show whose mom was mom, whose dad was dad, how the marriage tied them together. So it's not as easy as just an LOE as, hey, Daryl's my dad. That's not as.
I would be his son.
So, you need to go further than just an LOE.
Absolutely, guys. And documentation is paramount here. And it's never what I believe. It's always what we can prove. So, if necessary, ask those important questions up front. It'll save you heartache and time on the back end. Very, very important. Okay, we're going to go down to page 23, which was the next thing. Getting there. Excuse the technology here, but we're going here. And this is when we have to downgrade it a manual. Okay, so this is, it does give us an opportunity to do those, but knowing what the thing is, what is required is very, very important, guys. Okay, so mortgagee, and we would be the mortgagee, must downgrade and manual underwrite any mortgage that received an accept recommendation, even if it gets an approved eligible, if the mortgage file contains information or documentation that cannot be entered into or evaluated by the total mortgage scorecard, and that's by DU. So what is an example of that? If in fact there is an openly disputed account. Okay, so a disputed account, if it is disputed on the credit report, then AUS is not going to pick that up. Okay, so meaning, and also that credit score is not going to be indicative of that debt that's being disputed. So if it's a poorly paid debt and it's being disputed, it's not going to be included in the credit score. Well, we would have to manually underwrite that file because the credit score that we're using is not indicative of everything that's, that should be considered with it. So I was just one example, but keep in mind, it's pretty broad that if a file contains information or documentation that cannot be entered into or evaluated by total mortgage scorecard. Again, another one is a mortgage that doesn't report. If if they had a private mortgage or something like that and it doesn't report to their credit, then that would be a downgrade. Because again, AUS is not able to pick up the mortgage history, which would be a determining factor in the overall approval of the file. Now, it says the borrower has $1,000 or more collectively of disputed derogatory credit accounts. That's what I was just talking about. The date of the borrower's bankruptcy discharge is reflected on the bankruptcy documents is within 2 years from the date of the case number assignment. Doesn't exclude it, I'm going to say, but it does require it to be manually downgraded. The case number assignment date is within 3 years of the date of the transfer of title through a pre-foreclosure or foreclosure sale. So the borrower's had a previous foreclosure. We need to make sure that is recognized, and it will cause for a downgrade. Now, just on a side note, manual downgrade is definitely not a negative thing. It just restricts what your debt ratios can be. And we have to have some compensating factors, reserves, rental history, and those sorts of things. Does someone have a question? Okay, I thought I heard somebody trying to speak. The case number assignment date, okay, it goes on to say on the pre-foreclosure short sale, it says the case number assignment date is within 3 years of the date of the transfer title through a foreclosure sale. The case number assignment date is within 3 years to the date of the transfer of title through a deed in lieu foreclosure. The mortgage payment history for any mortgage trade line on the credit report used to score the application requires a downgrade as defined in within the housing obligations and mortgage history. And that translates to kind of what I was saying. If in fact it's not reporting, it could trigger a manual downgrade. or this is where it really is, the borrower has an undisclosed mortgage debt that requires a downgrade, or business income shows greater than a 20% decline over the analysis period. That's pretty big because, back last summer, we had a rash of self-employed borrowers. When calculating self-employed income, you have to be able to see if in this case, if 2022 is 20% less than income for 2021, then that is an automatic downgrade. So it's just simple as that. If you have self-employed borrowers, you need 2 years income. If your current year is 20% less than your previous year, know that the manual underwriting rules apply. I have a separate little chart and you can Google it as well, but to get FHA manual downgrade parameters, I have one that I'll make sure that we get out to you, and Darshan actually had it up here. And just to let you know, for a 500 to 579 score, your maximum qualifying ratios are 31/43. Okay, 31/43. For 580 and above, it is the same at 31/43, but you do not need any compensating factors. 580 and above, when your maximum qualifying ratios become 37/47, which gives you a little bit more latitude with one of the following: verified and documented cash reserves, minimal increase in housing payment, or residual income. So it gives you some caveats at 580 and above that will allow you to go to a 37 front and a 47 back end. Also at 580 and above, you can go to 40 back and 40 front, so 40/40 if they have no discretionary debt. That's pretty rare, but it is out there. And the key, and the one that we use most often, is you can go to 40/50 with two of the following. It's the same as before: verified and documented reserves, minimal increase in housing payment, significant additional income not reflected in the effective income, and or residual income. Now, significant additional income does not reflected in the income. Say if the borrower gets he gets a bonus, but I do not have the amount of tenure in that bonus to use it in the calculation, but we can clearly show that they do have that, they're getting that income, then that would be income that's not being used in the calculation and becomes a compensating factor. So any income that the borrowers have that we're not using in the debt to income ratio can become a compensating factor. That chart that I was just reading from, we'll get that out to all you guys so that you can, you can incorporate it into how you do your thing. Okay, so now we're going to page 33. Bear with me. Any questions on that so far while I'm scrolling here? All right. Authorized user accounts. This is for total, which means, AUS approved eligible, and any manuals, whether it be manual by downgrade or manual by debt ratio. Accounts for which the borrower is an authorized user must be included in the debt ratio unless we can prove, and this is normally customary, the primary account holder has made all the required payments for the previous 12 months. And if less than 3 payments have been required over the account, in the previous 12 months, the payment must be included in the borrower's DTI. So really the only caveat in which you can exclude it is with proof someone else is paying it. And that's normally customary. We go to the chat. I saw 3. How come I don't see them when I do this? Okay. All the way up here?
No, it looks like they're using the AI to take chats.
All right, okay. Sorry about that. Thought maybe I had a chat. Okay, so again, to exclude a payment, even like a co-signed debt, or in this case, an authorized user account, you do need to have 12 months bank statement, or proof of 12 months payments being made by the other party to exclude it. That's that's pretty big. Okay, so I'm one of the things that in calculating work history, a 2-year work history, which is necessary for all programs in FHA, you can use high school because we have a lot of borrowers. They're not the main borrowers, but families who are pulling together and the child has just been on their job for a year and a half, but previously they were in high school. With proof of that, with transcripts and or diplomas and what have you, you can use that as work history to make up to 2 years. So keep that in mind.
Question, just for 1 year, 5 months? Or just for they have to work 1 year and 5 months so they can count it with a high school diploma?
It just depends on how, it doesn't give any prerequisites. Now, I can't be in high school and just work 3 months and then, give me a diploma. It says if less than, I'm sorry, I'll just go to the page. Whoa, this was page. You don't have a page on there. Okay, so usually if you're trying to make up at least say 6 months of additional history to make it 2 years, then you would go with, then I can use their high school with doing it with as history. And it's the same concept as if in fact they were in college and gave me college transcripts. We're just saying that high school can be used in the same vein as college, as your college transcripts for a co-borrower.
I thought that the co-borrower from the university can go and work immediately, like they can qualify up to pay staff or to pay staff.
Right.
So they have the diploma. But for the high school, you say 1 year, 5 months working, and then the 6 months for the diploma to complete the 2 years.
Right.
So that's the difference.
Yeah, that is the difference. I wasn't making it the same as, I was using it as a correlation the same way that you look at college transcripts to make up work history. That's how I was using that correlation to say that you can do it similarly with high school. Okay, so if you do have a situation like that, I've only had a couple. I don't like to use the term case by case, but if you do have that, with your operations partner, have them bring it to me or Stephanie Legaspi. And by the way, we do have another underwriter, and I'll get out an introductory email. Stephanie Legaspi has joined us, and she has a wealth of experience. Some of you guys may even know her from working with her at previous locations, but she's a part of the team now, and she's just bringing in, not just the help as we continue to grow our volume, but she brings in a lot of knowledge. But that's a sidebar, and we'll send out an email in reference to that. But again, if you are, if the borrower has, doesn't have a complete 2-year history and previously they were in high school, we do want to be able to factor in that to make up the 2-year history. So depending on how many, and the stability of the job that they're in now, a lot of those things do come into play, but it is a factor to be used and something to be considered. So don't disqualify it because of that. Bring it to your operations partner's attention, and then we'll discuss it and figure out the best way to incorporate that.
Darryl,
Right.
quick question.
Yeah.
Did you say the maximum was 6 months they can use from the high school?
I didn't say the maximum was. I did say that, typically that's what we're going to look at, because the thing is Georgia, we want to make sure that they're stable in their current job. They're out of high school. They worked at McDonald's for 3 months, Costco for 2 months, and then, Burger King for a month. That's not showing, a trending of stability or anything like that. So it becomes more of a case by case, but we will factor it in. They've been in the same spot and I used a year and 6 months, because even on a W-2 borrower, that does kind of show a bit of stability. And, so I wouldn't use just 6 months as a rule of thumb. I would look more into the stability of their main source of income.
Okay, got it. Okay, I have one that's that right now, so I'll probably send it over.
Okay, on the one that you have, how long have they been working?
They're actually been working for about a year, but they've been in one job for 1 year.
They've been in the same job for a year, and then prior to that, they were in high school?
Yes, correct.
All right,
I think
see,
it's almost 14 months now.
that falls exactly into what I was saying. It's really, I say 6 months to be on the safe side, but it's gonna depend on the stability of the, of where they're working and their work history post-high school. So with that, if we have other, and again, these sorts of things are what's considered as layers of risk. If I have other compensating factors within the file that are strong, then by all means, I can be, I can look at it a bit more favorably. But if you have, weak ball ones and twos, and you're bringing in, the daughter who just got out of high school and worked 4 jobs, then you're going to have a problem. So it's always looking at the loan as a whole, and if we can, put together some compensating factors and some strengths to mitigate risk, then that's always going to be helpful. All right.
Okay, got it. Thank you.
Okay, so Darshan, that thing that I did send you about the child support, do you have that? Okay. Okay, we're gonna pull up another page, the page that's out of the 4,000, the FHA guidelines as it pertains to child support. And, because child support is, there it is, that's cool.
Can you guys see the page that's currently up?
It says users account.
Authorized user accounts.
That's all right, we agree, coming. That's there it is. Now you can see it. Right? Al, this is from the FHA guidelines. This is how it is explained for alimony, child support, and maintenance income. Now with this, of course, this refers to income received from the former spouse or partner or a non-custodial parent in the borrower's minor dependent. Okay, so the mortgagee, which is us, must obtain a fully executed copy of the final divorce decree, legal separation agreement, court order, or voluntary payment agreement with documented receipt. When using the final divorce decree, the legal separation, or court order, the mortgagee must obtain evidence of receipt using deposits on bank statements, canceled checks, or documentation from the child support agency for the most recent 3 months that supports the amount used in qualifying. All right. Now, the mortgagee must document in the voluntary payment agreement with 12 months of canceled checks, deposit slips, or tax returns. Difference is court order 3, the spouse, the parents get along and they have something off the record, we'd have to have 12 months. And it can't be just scattered payments, $50 here, $100 there. It does need to show some consistency in the payments, because we will always have to use the lowest or the most conservative calculation. The mortgagee must provide evidence that the claimed income will continue for at least 3 years. And typically with that, it's going to be the age. The mortgagee may use the front and pertinent pages of the divorce decree, settlement agreement, and or court order for showing the final financial details. And again, financial details meaning amount of children, number of children, and their ages. That has to be identified. This is where it gets interesting. Now, this is the calculation of effective income. This is how FHA guides us to calculate this. When using final divorce decree or one of the documents, if the borrower has received consistent alimony, child support, and maintenance for the most recent 3 months, the mortgagee may use the current payment to calculate the effective income. So if they've received it for 3 months, we can use what's on the decree or that legalized document. When using evidence of voluntary payments, if the borrower has received consistent support for the most recent 6 months, Again, consistent meaning in amounts, I may use the current payment to calculate the effective income. All right. If the support has not been received, consistent receipt for the most recent 3 months, if court ordered, or 6 months if voluntary, I must use the average income received over the previous 2 years to calculate the effective income. So consistency is the key in child support or any type of support or maintenance. If alimony, child support, and maintenance income have been received for less than 2 years, I must use the average over the time of the receipt. So that gives you a little bit of, liberty in how to calculate if it's less than 2 years. But effectively, that's what, that's where the change comes into play. If they've gotten it for court order for received for the most recent 3 months, if court ordered, or 6 months if voluntary, must use the average of income received over the previous 2 years to calculate the effective income. So that's the caveat, and the angles in which, the child support and maintenance and alimony and all of those things are received and calculated. We have any questions in reference to that? All right, I do see it.
Yes, Darryl, quick question.
Go ahead.
I had one that they received it voluntary, and but I don't know, they have to be receiving it already 12 months if they just started. Is that something that can be explained, or what's the minimum that they would need to?
The guideline is pretty clear with that. It doesn't give me up to 12 months. It says the mortgagee must document voluntary payment agreement with 12 months of canceled checks, deposit slips, or tax returns. You're saying that they received it for less than 12 months? Is that what you were saying?
Yeah, because they just started, so I think it's been like 8 months. Yes, it's been like 8 months.
Now, it doesn't give any caveats. I will look at that and see if in fact, depending, the strength of it, if in fact, it's a consistent amount and they have a written agreement, to what they're going to do, and he's been following that. I'll see if in fact I can use that. But, I'd have to escalate that to the HOC because, they're really clear. They didn't say up to 12 months. They did say 12 months. But, hey, I'm on your team with that. If you have it, make sure it's documented solidly, and I'll see what I can do.
Okay. And one last thing, this gets grossed up and
George, could you say that again? You sound muffled.
sorry. Then one last thing, does this get grossed up as well?
No. I have never grossed up child support. Yeah, and it's usually only non-taxable income, and this is. But and because of that, what I'll do is in the next one, I'll make sure that we'll cover what can be grossed up. Because because grossing it up, you can gross up, you like on Freddie and Fannie, you can gross up to 115% with no additional documentation. If you want to gross up 125%, you got to have proof that it's not taxed. So, I'll go through grossing up income in detail, but that's one thing to keep in mind, guys. Just take that with you. If you need to gross up income, we can gross up 115% without any additional information, like say you're providing bank statements for proof of Social Security. If you need to gross it up past 115%, we got to prove it's not taxed. All right. So we covered a few things today. I mean, I could, I got a half an hour, so I can jump back into the lender training deck, and we're still sharing. Yeah, good. And just go through a few other topics on here as it pertains to, for instance, total versus manual. Total just means obviously a U.S. approved versus manual when we have to downgrade it. Effective income, and I just use that term when with the calculation of child support and what have you. It refers to the income that may be used to qualify the borrower on for a mortgage. It must be likely to continue through at least the first 3 years of the mortgage. So the underwriter should always be looking for that, and we do. Be documentable, legally derived, meaning we can't use, I know it's a lot of grow houses and things like that until it's with this being a government-based loan, it'd have to be legal in all 50 in order for us to use that. Be reported to the IRS when required. We can't use, cash and, we can't use unreported income. And we do have to subtract any negative income from the borrower's gross monthly income. This came up before when we had a borrower who we were just using their W-2 income. They had a side bar Schedule C income. They didn't want to use that, so they didn't want to factor it in, but we had to use the tax returns. If that negative income is in the tax return, we do have to use that in the calculation. The only time that we have not in the past is if it's been proven beyond a shadow of a doubt that that company no longer exists. If FHA requires tax returns for any type of effective income, the mortgagee must this is just telling us we have to look at the different schedules, Schedule E for rental, Schedule C, sole proprietor, 1065s, and what have you. Okay, employment-related income. For all employment-related, the mortgagee I have to verify the most recent 2 years of employment and income and document current income using traditional alternative methods. Now, excuse me, I have a file right now in which the borrower was, she's worked a couple of jobs. It was over the last, let's say, 3 years. And it was a gap. She had only worked from, let's say, March of last year until present. Prior to March, got an LOE that she was off work because her mom got injured and she was taking care of her mom. Now, she wasn't on any, I'm talking about the borrower, wasn't on any type of disability or anything like that. She just was not working. So that all that was provided was 18 months. In this case, I need to have where she worked at before that she stopped working to go to care for mom. You have to put together 2 years of employment. Okay, so keep that in mind when if you have a situation where there was a gap, and gap just wasn't working. Not that they were laid off or furloughed or whatever. But in that case, they're not working. You do need to put together at least the previous time necessary to make up the 2 years. Just keep that in mind, please. Mortgagee must obtain one of the following to verify. This is pretty common knowledge. Recent pay stub and a VOE covering 2 years, or direct employment. That's like the work number. So keep in mind it's always going to be 2 years income, and VOEs are your best bet. When doing a VOE, when providing a VOE, guys, we want to make sure if it's a written VOE, you want to make sure that if they're getting overtime, that overtime, the box is checked yes. If it's blank, FHA considers them not approved overtime. So we always want to make sure on a handwritten VOE, if they get bonus, if they get overtime, the box, I believe, is box 13, but regardless, on a handwritten VOE, if they're getting additional income, make sure that that is checked. I know that I've talked about this a few times. When calculating income where the borrower's hours vary, to benefit the borrower the most, we definitely need to get the amount of hours worked the previous couple of years, because say they got an increase. If I'm just using averages, I'm not giving them full credit for what they're earning now. Now, I can't just use the hourly rate because they don't have consecutive 40-hour weeks. But say they got an increase. I have one now where the borrower was making $15.50 an hour for the last 3 years, but in March he got a raise up to $24 an hour. Now he doesn't work but 30 hours a week. So instead of in order to maximize the income, those previous 2 years, give me, if we had from the employer the average amount of hours worked, the hours worked in that year, I can multiply that by the new hourly rate. And in this case, this could make or break the loan that's in my head that this example comes from. So guys, these are just things from an underwriting perspective that I see and opportunities for us to take care of. All right, dipping back into this past employment documentation. If the applicant has not been employed with the same employer for the previous 2 years and/or not all conditions immediately above the previous can be met, then the mortgagee, meaning us, must obtain one or a combination of the following for the most recent 2 years to verify its employment history. And this is common sense, W-2s, VOEs, or work number VOEs, which is directly from a third-party vendor. That's what TPV, third-party vendor. Re-verification, we know that VVOEs, that's an operational thing. We need to verify right at closing that the borrower is still employed where we qualified them for. So if in fact they had not been, let's just make sure they are. Here's my favorite topic, overtime bonus or tip income. The mortgagee may use this, meaning we can use this. The borrower has to have received this income for the past 2 years and is reasonably likely to continue. Periods of overtime less than 2 years can be considered effective income if in fact it's been earned over a period of not less than 1 year and it's reasonably likely to continue. And the job is going to tell us what that is as well. The calculation, this is one that I know that I've covered with you guys quite a few times. It says that employees who receive overtime bonus or tip income, the mortgagee must calculate the effective income by using the lesser of the average over the previous 2 years, or if less than 2 years, the length of overtime bonus tip income has been earned, or the average over the previous 1 year. So again, you see the one thing that you do not see there is year to date. It's over the previous 2 years. If less than 2 years, how long it's been earned, or over the last 1 year, whichever is less. All right, we don't have to worry about this as much.
What is the minimum of an overtime to be considered?
1 year.
No, but the time, the 3 hours and month or something that is.
It's no minimal. It's no minimal.
So even if they can give 1 hour a month is considered.
We don't look at the hours. We look at the amount and the dates. So it doesn't matter, if they get $20 a week, 52 weeks. That's what what's that? It's $150 or whatever. It doesn't really matter, the amount of hours. We just looking at the totals and the tenure. Totals and how long they've received it, and that's where the averaging comes in. So that's why.
Darryl?
Yeah.
I have a quick question in regards to this. What about when a borrower changes jobs, and in the previous job he was getting overtime and he was working consistent overtime, and on the new job he continues to have overtime? Is there a requirement as to a gap of employment that will disqualify the overtime from being utilized?
Well, really and truly, if in fact he earned overtime in his previous job and he earns it now, the job employment gap is, that has to be explained as a separate condition. But if it's all about the history of receiving overtime. So if we show that they do have a history of receiving it, then it can be calculated in. But one thing that I cannot do is prorate. So say they worked 9 months this previous year, 9 months in 21 and 12 months in 22. I would have to take those together and divide it by 24. I can't prorate just 9 months overtime and 12 months of overtime. That's the caveat that FHA uses. But if they have, if there is a gap or it's less than, it's still, effective income.
Thanks, sir.
Good question. Good question. Still effective income. Okay, seasonal employment. This doesn't come up much, but we are heading into the holiday season, so it may come up as the year comes to an end. If in fact, every year the bar goes to work for UPS, every year they go to work for Macy's or something like that. It's right now. I'm sorry.
I got a file in front, perfect, this is perfect.
All right. The mortgagee may consider seasonal employment as effective income if they have worked in the same line of work for the past 2 years and is reasonably likely to be rehired for the next season. So, again, this really comes into play. I use Macy's because I'm an East Coast guy, and my aunt, she used to every year during the holiday season, for as long as I can remember, she always worked at Macy's for the holiday season. Or a lot of people work at UPS or some of the package deliveries, now Amazon. If they do that seasonally and I've got a history of it, then I can consider that. Okay. So the key for using seasonal income is that they've done it before and they're doing it again, hopefully with the same employer, because the regularity is almost as important as who it is. Okay, I mean, vice versa. Who it is almost important as regularity. I'm sorry, it's early, man. It's early. All right. The mortgagee may consider unemployment income as effective income for those with effective seasonal employment income. So if they get seasonal employment and they do get unemployment after that, FHA will allow us to consider it. But not all people with employment, with the seasonal employment will get overtime. All right, calculation for employees with seasonal employment income, the mortgagee must average income earned over the previous 2 full years to calculate the effective income. For seasonal employees with unemployment income, you must document the unemployment income for 2 full years as well. And there must be a reasonable assurance that this income will continue. So again, that's where the regularity of who they worked with and the fact that they do give them unemployment when they're out of season, then that's going to be a big factor. I wouldn't be able to use that if they're switching employers unless, you give me a job letter. Well, actually it's the previous 2 years. So if they're continuing to work for that person, then I can do it. If they've changed to another employer, then I wouldn't be able to, because it's the last thing, reasonable assurance that this income will continue. So a couple of caveats on this page for employees with seasonal income. The mortgagee, meaning me, must average the income earned over the previous 2 years. All right, it's not what they make. It's not their year-to-date pay stub. It's what they've done over the previous 2 years for seasonal employment. Commission, same deal. The mortgagee may use commission income if the borrower's earned income for at least 1 year in the same or similar line of work, and it's reasonably likely to continue. I have this a lot with people in car sales. They can work for one car sales and to another, and even if they're, I don't want to say jumping around, they work for maybe 3, places in the last 3 years, 2-3 years. Well, they have, a history of earning commission, then we're going to give them that and we're going to use it as effective income. So that's where that second part of that sentence, or similar line of work, it really does stand true with commission income. If they're in a commission earning capacity, then we will do that. Now we'll tell you that if they go from car sales to shoe sales, it's going to be, a bit of a caveat, if in fact they earn a greater amount of commission than what their year-to-date commission is, it's going to be hard for me to make that case, or it will be, it will affect the calculation. But historically, I've dealt, this is, for our car sales borrowers. Okay, required for all commission must use a traditional or, same documentation. WPOE is what we're going to need, really and truly, because they're going to have to break it down. All right. As effective income, I have to use the lesser of, and it's the famous thing, income earned over previous 2 years for commission, earned for 2 years or more, or the length of time commission income has been earned if less than 2 years, or the average commission earned over the previous year. So that's the same, that doesn't change. But and really the rule of thumb is anything other than base pay, you're going to need 2 years in order to use that as effective income on an FHA loan. And if you have less than 2 years, obviously there are caveats for it, but that calculation is not conventional. Now, exception due to COVID, I have been skipping over these because as that becomes more, COVID becomes more and more in our sunset, it's, these don't really apply. But historically, 2021 was a COVID year, so I can use this theoretically. For employees with commission income, the mortgagee must calculate the effective income of the average income in accordance with commission income standard section above for the time of a COVID-related event. Instead of going into great detail about that, because even in the training, we didn't spend a lot because of its if that sunset mentality of it being far in review. If you have any borrower in a commission or any income other than base income that we need to factor that was affected by COVID, then let me know. And then we can, work on that on a case by case, or Google is your friend. You can easily Google FHA's COVID rules for greater detail.
So for example, a nurse that got like COVID paid for the extra hours they did, use them?
It depends on how it's reported. Because, if there is a spike in income, you also got to take in consideration when using averages of income. If your previous year is considerably less than the prior year, then we're gonna use the previous year. So even if they did, because yes, they were making a gang of money during the COVID years, if in fact 2021 was larger than 2022, then 2021 is going to be considered the more effective income. All right. Good question. Self-employment income, of course, refers to 25% or greater ownership. Self-employed, consider self-employment borrower has been self-employed for at least 2 years. And of course, if the borrower has been self-employed between 1 and 2 years, I may only consider his effective income if the borrower is previously employed in the same line of work in which the borrower is now self-employed as, or in a related occupation. Income obtained for a business with annual earnings that are stable or increasing is acceptable. So you have to, if you're using, business income to qualify, then, we're going to have to look at the previous 2 years to make sure it is stable or increasing. It can't be decreasing. The income for business shows a decline in effect of 20% or more over the analysis period. The mortgagee, I have to downgrade that. And we spoke about that earlier when we were talking about downgrading. If in fact that income has decreased 20% or more, we have to do that. Now, I may consider income stable after 20% reduction if I can document the reduction was a result of extenuating circumstance. First thing comes to mind is COVID. Or the borrower can demonstrate that income has been stable or increasing for a minimum of 12 months, and he qualifies using that reduced income. Now, this is, it's pretty common sense, but, if in fact it has been reduced, we do need to document and address why the reduction of 20%, depending on the industry or the way that income is earned. We do need to justify that. That 20% drop is not going to turn into a 40% drop and what have you. And a lot of it's speculative. So building a case, compensating factors are always going to be, going to be helpful in a case such as this. But in extenuating circumstance, one thing that I always comes to mind when I see extenuating circumstance is to remind people that divorce is not an extenuating circumstance. If you have a reduction in income due to a divorce, that's not considered an extenuating circumstance. A little sidebar. All right. Exception here. Again, this is more of COVID related. And again, I'm not going to go through that as detail. And if any of you want to go through COVID type of situations, please give me a call and we can get on the phone and talk about it. But I don't think that would affect everyone. It's not probably the best use of our time right now. Documentation, I must obtain complete individual tax return for the most recent 2 years, including all schedules. Obtain the business tax returns, including all schedules, unless the following criteria are met. Individual income tax return shows increasing self-employment income over the past years, and the funds to close are not coming from a business account. And the mortgagee to be insured is not a cash out refi. So for purchases or non-cash out refis, this is where that applies. So if on the regular schedule, the business income shows that it's increasing, then we don't need that if we're not using the income from that. For manual, I must obtain for the most recent 2 years, including all schedules, and the business credit report. I haven't, it says mortgagee must obtain a business credit report for all S corps and corporations. That's not something that has been readily enforced, because we're able to ascertain much of that from the loan documentation. Okay, this is key. On for all self-employed borrowers, I must obtain a year-to-date P&L and balance sheet if more than a calendar quarter has elapsed since the day of the most recent calendar or fiscal year-end tax period. Very few self-employed borrowers are filing their taxes on a fiscal, so this is typically going to be on a calendar first quarter after in the first quarter. So if we're doing a loan from really and truly, I'll say from July on, but definitely August on, we're definitely want to get a P&L. But as a rule of thumb, the only time that we're not going to need a P&L if it's a Schedule C. So if you have a self-employed borrower, tee it up at the beginning so you don't have to go back to them for it. Unless it's a Schedule C, automatically ask for a P&L. If income used to qualify the borrower exceeds the 2-year average of the tax returns, an audit P&L or signed quarterly tax return must be obtained from the IRS. So this is a very, very rare occasion, and I definitely wouldn't bank on this. Like, okay, so my average over my last 2 years is $10,000 a month, but now he's making $20,000 a month, and I want to use $20,000 a month. The proof to that is like extracting DNA. It's not as simple as just giving me an audited return. That audited return, it has to be something that you really want to have a quarterly tax return that was signed. The signed quarterly tax return is really the only time that FHA is going to favorably allow you to use a higher than the previous 2-year average. An audited P&L, I'm telling you, that's a rabbit hole. Again, here we go with the COVID. I cruise past those. In lieu of individual business returns from the borrower, mortgagee may obtain the 4506 for requested a copy. Now we get the 4506 on all of them. What we are going to start doing more so than transcripts is getting statement of accounts, unless if there's something that pops that require us to get transcripts. But we are looking into, if that is a more expedited process. If it's cheaper and quicker, then by all means, we're going to definitely go with the statement of accounts. But on your tax returns, keep in mind when you have a tax return, always look on the
It's turning off. Wait.
if you do have
1 second.
Okay.
Great.
All right. Dang, I forget what else you already said. Oh, okay. On tax returns, always, guys, on your 1040s, look at that page 2. I believe it's line 37, and see if that borrower owed anything. If they did, you can give your operational partner a leg up by requesting either proof or if in fact they were in a payment plan. And that's something that can be done in origination when you're gathering the document. If you have tax returns, flip that page and look at the bottom of page 2 of the 1040 to see if in fact they have any, if they owed anything for that tax year. Okay, and I really just look at the current year. Now we're going to get a statement of accounts. Now that statement of accounts is going to tell me, that they did owe, or if they owed and they paid. But the trigger and the benefit for you is if you can ask to see if they're in a payment plan. And that payment is going to have to work in your debt ratio, and that's not going to be part of what's on your credit report. So, and it could take you over the edge, whether it's a manual with the 40/50 restriction, or if it's a standard approved eligible, it can go up even higher. So always, hindsight being 20/20, I always look at that. Payment plan, okay, yeah, Darshan just triggered me. If they do have a payment plan, we do want to have proof that they've been in there and they've made payments for 3 months. And that's standard, but it does stand to reason that we remind you. This is, the way that we're doing this now is how I'm going to pick up from here on our in our next meeting, because I just think that going through these pages, because the guidelines have been updated, there's new changes in the 4,000, which is the FHA guidelines, is going to be effective next month. But those changes were included in this training that we had a couple of weeks ago. So, and nothing earth shattering, but they have, softened it a little bit, because, when we first sat down, the head of the home, of the HOP said that, they're really trying to open it up to be able to assist even more people. Another gentleman who was the head of valuations, he said to me personally, he said, man, I believe that within the next 12 months, we might be the only show in town, considering how rates are going. So FHA loans, and we got a lot of leeway, and they do have a lot more flexibility, in their lending practice, but the documentation requirement is a little bit more strenuous. It is the government, but, let's not forget. But, on FHA loan, you guys know how beneficial they can be in opening the door for even more borrowers. Volume last week, thank you guys for sending it in, was starting to pick up a large amount of FHA loans. Let's keep that going. And, never tell yourself no, because we don't have no problems with other people telling us no. So if you have a difficult loan, let's get that scenario in and let's talk it out and see if we can bring something to it. Before we go and see if there's any questions, I'm gonna pop back into the chat. Okay. What about borrowing a middle transaction, changes job, how that impacts the transaction? Depending on what they're changing their job to. Okay, because now if they're going to an hourly rate where job letter says that they're guaranteed certain amount of hours and whatnot, the changing is not the thing, it's the prior history, making sure you have 2 months. And if they're going to be a W-2 or an hourly borrower, that's then we're going to want the pay stub, but that job letter and a pay stub which confirms what you got, what the earnings is going to be, then that's not going to be a huge impact. It just really depends on what it is. If they're changing things holistically, they're going from a supermarket to a factory, those things change, but really changing the job, in the middle of this transaction, only thing the impact is it might elongate it, because we're going to have proof of receipt of that income. Okay.
Yeah, and Darryl, thank you for the explanation. Because I had an experience on one of my files previously that were not or was declined because of this. So he was working and suddenly he got a better offer for doing more overtime. And then reason why is not proof that there should be at least 2 years in the current job is the reason why it was declined, and my escrow was full because of that. That's why I asked in this situation, in real case,
Right.
how to proceed.
I mean, just what we were saying, and everything that we were reviewing, I didn't say everything, but reviewed a couple times, when effective income, they only talked about history, 2-year history. It didn't say 2 year in the same job. The only time that came up was on a self-employed borrower, in which they were going from working a job into self-employment. It had to be the same line of work. But I mean, we were talking about how combining job history, throughout. So no, as long as we got stability and proof of receipt of that income, that's just like a job letter. We wouldn't not allow a kid coming out of college going into their profession. They earned a few paychecks. We would still use that as effective income. So it's not so much on the same job, it's the 2-year work history. That's where that's where it's really more prevalent.
Yeah, I'm happy to hear that right now, but I am very sad because 2 years ago my file was full because this reason. So he used to have more than 3 years on the previous job, and this new job was offering the same line of job, but not good, better overtime, and of course better income. But the reason was like job change and then was decline my file. That's why I flag this question, because I need to be clear if I have a new case again, because this what in reality happening on the field. We find a lot of challenges and objections in the moment when we deal with the transaction.
Welcome to iCore, because we are definitely, I mean, anybody on the phone who I've, dealt with individually, that I'm going to work with you to see the best way to get it done. Now, I do want the loan to close and stay closed, but, I am going to work with you to do whatever I can. But in a case like that, we were just going through, the training manual, and it clearly never mentioned in the same line of work. The only time that was when they were going from a W-2 to self-employed. So that's the only time. So yeah, we would have figured that one out, and it also depends on the strength of the income documentation to the new job. That notwithstanding, we'd have to have a firm job letter, proof that he's received that income. So that's why I say the impact, it may stretch the process, but it wouldn't eliminate the loan. Okay, you have a question?
So how would you handle, for example, someone that has a base salary and prevailing wages, like they're a plumber for a city, and so they get paid by project with prevailing wages?
Okay, I've had, prevailing wages quite a few times. In a case like that, you're dealing more with averages again. I would, hopefully they've been there for a couple of years.
They just started
with the prevailing wages, then that would be hard, because prevailing wages is not guaranteed. That depends on the job, because, you could get a prevailing wage as a plumber for a building that you're not going to get to redo her sink. So I wouldn't know how many times you worked at the building if I didn't have it to average. So prevailing wages on a new hire, you wouldn't be able to use it, because prevailing wages almost look like overtime, bonus, and all of that, even though it's part of the contract. But, you would have to be able to average
2 years.
2 years. 2 years. I'm going to say 2 years, less than 2, but more than 1. We can see what we can do. But really and truly, that is going to depend on the longevity of receiving it. Because prevailing wages, and that's the same thing, like, with differentials for our medical professions. A lot of times they get all these different differentials. We're looking at the total. And when they do have a lot of them, we're looking at the average. Because again, these differentials, if they fluctuate and they don't get it all the time, then it's hard to use that as effective income. Oh, it's income, but the difference between income and effective income is qualified.
If it's for like the government position, like the city, does that support as far as maybe calling in getting some kind of a DOE that states?
Again, if they just started, then they don't have no history of being able to be assigned to these prevailing wage jobs. Now, if the job letter says that he's going to make $45 an hour, and every week he's guaranteed $75 an hour on 3 hours of prevailing wage job, if it spells it out, then, and I have, proof that he's done it, he's made it a couple times, then I can probably make a case for it. Maybe not FHA, but I could probably make a case for it. But again, that's going to be rare. If it was prevailing wages and they would know how many hours a week that they would do that, that's going to be more contractual. So it's just going to depend on how rich your documentation is. Prevailing wages is one of those things. I'm telling you, if you look at prevailing wages, you look at it like you would overtime and bonus, more so than you would straight hourly income.
Oh, thanks.
That was a good question. Any more questions? I like good questions. All right. Well, guys, no other questions. I'm over time, which I really don't mind at all today. If anything that we discussed, now and you had questions that you didn't want to ask in a group, I always say this, please, guys, send me an email or give me a call. And, and I do whatever I can to help you, because it's to my advantage, our advantage, to learn from this. And again, I'm going to send out a welcome email for our new underwriter, who's she's pretty amazing. So we got even more help. I've been good with our turn times. I've never went past really 24 hours. But now, with the additional help, even on the more difficult loans, we can give you even better service. And I'm all about communication. So if you have any questions, please don't hesitate. All right. Thank you guys for joining us this morning.
Glasses?
¿Quieres la próxima vez? ¿Quieres?